In our previous lecture, we have been able to solve a question on adjusted present value, right? Then someone, I think Mr. Moses asked question. That is why I said I every questions are so important to us. Now, Mr. Moses asks one question that this cost of debt of 5% that we use to discount this project. So it's supposed to be commercial rates. I say no, it is pre-tax cost of debt of the main company class. But guess what? But but there is subsidized loan, subsidized rate of 3%, and there is commercial rate of 5%. And I said that it is pre-tax cost of debt. So which one of these pre-tax? Is it the subsidized or the commercial? I said it is what? Pre-tax cost of debt. And the cost of debt is the cost of borrowing. The rate, let's say the subsidized rate in this question is 3%, right? The previous question that we saw. Then the commercial rate is 5%. Now, and I said, use pre-tax cost of debt of the main company. The question is, you have subsidized rates of 3%. You have a commercial rate of 5%. The both of them are what? Are cost. So which one will you use? So you use the commercial rate. You use the commercial rate. That is why we use the commercial rate of 5%. You can actually change that in your notes. You use commercial rate of what? Of 5%. Because commercial rate will be higher than the what? Than the subsidized what? Rate. And that is what you use to discount your project. And that is why we use 5%. Mr. Moses, are you still on this call?
Yes, sir. I'm here, sir.
Okay. Right? Because I said use pre-tax cost of debt of the main company class. The pre-tax cost of debt of the main company are two. Debt. The subsidized, and the commercial. The question now is, you have a commercial rate of 5%, you have a subsidized rate of 3%. They are all debt. So which one of these debts will you use? So you use the commercial rate. And that is why we use it as what? The 5%. So I needed to correct that, right? I needed to lay emphasis on that so that you will understand that you use the commercial rate, right? You use the commercial rate. Thank you. Now, today's so I have two questions here. We'll do one today. We'll finish it. We must finish this question, right? Then on Saturday we'll complete the other question. Class. This question is 30 marks, right? This question is 30 marks question. So we'll look at this question together. Rachel.
Yes, sir. Good evening, sir. Can you hear me, please?
Yeah, me too. Go ahead.
Okay, based on what you just explained now, does it mean we need to always go for the highest percentage or what?
No, it's just the one of the commercial rates will always be higher than the subsidized rate. So you go for the commercial rate.
Regardless of the differences.
Yes, regardless of the question, commercial rate will always be higher.
Okay, sir. Thank you, sir.
You're welcome. Do you know why it's like that? Because you have a subsidized rate of 3%. You have a commercial rate of 5%, right? So the law, what the principle says that you have to use the commercial rate to discount what? To discount the project, that is the PV of the financing effect. Thank you. So we'll look at question 2. I'm sure 20%, okay, we are 19. I think about 18% of those who are in this class should have their material, right? So question 2, please let's pay attention to this question. Is examinable. Please pay attention and ask question when necessary, right? Please. So required. The first required is calculate the adjusted present value for the project, correcting any errors made in the net present value, estimate above, and conclude whether the project should be accepted or not. Show all the relevant calculations. At the end of this class, maybe by the end of this class, I will tell us what is it called. I just have like 2 minutes gist, right? So we have some things to discuss. Practical on investments, on capital investments. Comment on the corrections made to the original net present value estimates and explain the APV approach taken in part A, including any assumption made. You can see that assumption is very important. You assume you have your 8 marks. Comment on the correction made. What are the corrections that you made based on the above? And include it, your assumption. So the total marks is what? 30 marks. Class. So your company, FPLC, so we have to calculate adjusted present value. You already know that the required is that calculate adjusted what? Present value. When you want to determine adjusted present value, you need 2 items. The base case NPV as well as the PV or financing effect. Both. So whether you subtract or you add, you have your APV, then you make your decision. Don't forget, when you want to do your base case NPV, you use the ungeared cost of capital, ungeared cost of equity to discount the project for the base case NPV. And base case NPV is the normal NPV, but what you will use to discount it is the ungeared cost of equity. Ungeared, that is the project company. Ungeared. It is assumed that the project will be financed by what? By equity. And that is why you have to use the cost of ungeared cost of equity to do what? To discount it. Using the what? The base case NPV. Now, your PV of financing effect. We have how many steps? We have about 6 steps. You must know it when we get there. 6 steps. Right? Then, after that, what do we have again? You use the commercial rate to discount your PV or financing what? Financing effect. The commercial rate will always be what? Higher than the subsidy. Just like the current interest rate from CBN, the NPR is 27.7%, while the bank will be lending at the rate of 30%. And government is now saying that, oh, don't worry, instead of you borrowing this month at the rate of 30%, we'll give you at the rate of 20%. That is subsidized what? Rate. You can see the commercial rate is 30, the subsidized rate is what? Is 20. Now, your company, FPLC, produces and sells high quality tomato paste in Kano. The product is sold locally across the country and exported. Now, before I move further, adjusted present value is the combination of both your risk-adjusted cost of capital, the knowledge of risk-adjusted cost of capital there, then capital what? Capital. So once if you don't understand risk-adjusted cost of capital, there will be a problem here. If you don't understand capital budget, money, cash flow, real cash flow, money cost of capital, real cost of capital. We'll do that here again. So get prepared. And export to a number of African countries. Following recent government policy on rice importation into the country, the company is now considering setting up a rice mill in Kaduna State. Please make sure you are with your writing material and your calculator, please. The following net present value estimate has been made for the what? For the project. The following net present value, they make the net present value before now, and this is their own net present value. Can you see it? Now, net present value is negative. Oh, the net present value is negative, and therefore, the recommendation is that the project should not be accepted away. Now, the recommendation is now that based on this that has been done earlier, right? The recommendation is that the project will not be what? Will not be viable. Now, in calculating the NPV of the project, the following notes were made. Right? The following notes were what? Were made. What is the first note? The first note is that since the real cost of capital is used to discount cash flows, so neither the sales revenue nor the direct project costs have been what? Have been inflated. It is estimated that the inflation rate applicable to sales revenue is what? 8% per year. That is the inflation rate. What it means is that your sales will increase by 8% per year, and the direct project cost is what? 4% per year. Now, what it means is that this is the real cost of capital. Inflation they've not projected this particular NPV with the inflation. They've not, right? And that is why they say what they use to discount it is what? Is real cost of capital. And don't forget, real, without what? The effect of inflation. Then now, you have to inflate it, right? By 8% specific inflation. You have to what? You have to inflate it 8% per year on what? On sales. And to the direct project cost, you have to increase the direct project cost by what? By 4% to take effect of what? Inflation. That is what? When you increase it, it becomes a what? Money cash flow. Right? Now, the project. What happened to the project? The project will require an annual investment. The project who is this? The project will require an annual initial investment of 760 million, right? The project will require what? An annual investment of 760 million, which means that when they want to do this project, they will need an investment of 760, right? Which is shown above. Of this, 320 relates to machinery, plant and machinery. Out of this 760, right? Out of this 760, 320 will be what? Will be applied, will be applicable to what? Plant and machinery, which is expected to be sold for 80 million, which means that the plant and machinery is expected to be sold at what? At 80 million. Don't forget, the total investment is 760, and this inside the 760, you have plant and machinery. And this plant and machinery of 320, it is expected to be sold at what? 80 million when the project ceases. After taking any taxation and inflation impact into the account, it means that they've taken consideration of inflation as well as what? Tax. Class, are we still together?
Yes,
Are we
sir.
together?
Yes, sir.
Okay. That's fine. Now, tax allowable don't forget this, please. The investment is 760. Out of 760, there is plant and machinery of 320 inclusive. Then, and this plant and machinery will be sold at 830 after taking consideration of tax and inflation. Please take note of that. Tax allowable depreciation is available on the plant and machinery, which means that can you see it? The plant and machinery, there will be tax allowable, right, of what? 50% in the first year. In the first year, the plant and machinery is 320. You will not charge capital allowance so on the 0760. You were told that the plant and machinery is 320. So when you want to charge, it is tax allowable. So which means that you charge your capital allowance in the first year, 50%, right, instead of depreciation, followed by 25% per year thereafter, right? After the first year, you charge the capital allowance to be 25%. Then after that 25%, you will now therefore on a reducing balance. Therefore, you will not be reducing it. It will not be on a what? On a reducing balance. Class, it will not be on what? On reducing balance. We'll get there. Now, a balancing adjustment, okay. A balancing adjustment is available in the year the plant and machinery is sold, right? Which means that at the last year, when you dispose an asset, at the last year, right? Don't forget, you will not claim capital allowance on it unless you make a loss on disposal of that particular asset, right? So definitely a balancing adjustment will be allowed because the plant and machinery has to be sold at 80 million, right? 80 million at the end of this project. Therefore, we will account for either it is balancing allowance or balancing charge. FPLC pays 20% tax on its annual taxable profits, which means that they paid it. It is not in arrears. They paid it in the year at which the profit is made. No tax allowable depreciation is available on the remaining investment asset. Can you see it? Class, 760 minus 320. What do you have? 760 minus 320 will give you what?
440.
Class, 440. Thank you. So which means that the 440 will not be allowed for tax, allowable depreciation or anything. And they will have a new value at the end of the project. The 440 will have a new, right, at the end of the project. Now, FPLC uses either a nominal cost of capital of 11% or real cost of capital of 7%. Class, don't forget that at the beginning of this project, what they use to discount it is 7%. And this 7% is a real cost of capital because you've not considered what? Inflation. And don't forget, all this cash flow, they are real cost of capital because you've not taken what? Cost of real cash flow, because you've not taken consideration of what? Of inflation to reflect the money cash flow. And that is why they said at the beginning that the revenue will increase by 8% per annum. You need to take effect of that. You know, when you increase your revenue by 8%, it becomes your money cash flow. Then when you have your money cash flow, you will use money cash flow to discount. So you will use what? Money cost of capital to discount. When you have a money cash flow, you use the money cost of capital to discount or the nominal cost of capital. But we are lucky in this question that the nominal cost of capital is given as 11% or the real cost of capital of 7% to discount all the project. Of course, we can't use this real cost of capital when we inflate the revenue by the 8% stated earlier because this is real. It does not consider inflation, which means that we have to use 11%. to discount the project because it includes what we call the money cost of capital, which means that inflation has been taken into what consideration. And however, in another way, Ican may decide to remove this or remove this 11% and give you just real cost of capital of the 7%. Then you will now ask yourself, will you use this 7% to discount the project? No, you can't use the 7% to discount the project because you've already inflated your cost. You've inflated your revenue, you've inflated your direct cost, right? So when you inflate it, it becomes money cash flow. So you can't use money cash flow. You can't use real cost of capital to discount what? Money cash flow. It is not possible. Now, which means that you need to convert. You need to convert this real cost of capital to money cost of capital so that you can be able to discount it with what? The money cost of capital. But in this question, we're given as 11%. But however, if you want to test it, you will have 11%. Given that the rate of inflation has been stable at 4% for a number of years, this is the general inflation attached to it. So which means that if at all I can want to bring in, probably I can want to lock this question, I can may decide to remove this part and tell you that FPLC uses real cost of capital of 7% to discount all projects, and they will give you the inflation what of 4%. So what you need to do is that use the real cost of capital of 7%, convert it to money cost of capital or nominal cost of capital. When you convert it, you will have this 11%. Then use that 11% as the nominal cost of capital to discount. So we don't need to calculate it again, but I will test it. We will test it together if we will arrive at this 11%. Class, are we still together, please?
Yes, sir.
Okay, that's fine. Okay. So if that is established, we move to the next one. Interest is based on, we are moving to financing now. Interest is based on FPLC normal borrowing rate of 150 basis points. Class, what is 150 basis points? What is 150 basis points? What does that indicate?
150 over
That
100.
is the 150 over 100.
So 150%, right? That's fine. So over the 10-year government yield, please mute your mic. Okay. Over the 10-year government yield, you can see interest is based on FPLC normal borrowing rate, 150%. Over the 10-year government yield, the normal borrowing rate is 150%. That is 150 basis points, right? 150 basis points, 150 over 100, that is 1.5%. 1.5, you have, no, you have 1.5, right? 1.5%, right? Now, at the beginning of each year, we'll get to that part, that is financing effect. At the beginning of each year, FPLC will need to provide working capital of 20%. There will be a working capital in this question of 20% of the anticipated sales revenue for the year, which means that the sales revenue that you will increase, class, the sales revenue that you will increase, you have to charge 20% on it as your working capital. Then any remainder, what happened to it? Any remaining working capital will be released at the end of the project. Don't forget, working capital is what you use to start a business. For instance, I use 100,000 naira as at the beginning of January to start Next Gen Professional for running costs, right? At the end of April, what will happen at the end of April? I will recoup back my investment, all what I've spent from that period till date. I will recoup it, right? And that is what? That is working capital. Now, it is anticipated, please pay attention to this part. It is anticipated that the project will be financed entirely by debt. Please pay attention, please. It is anticipated that the project will be financed by what? by debt. Entirely. All the project will be financed by debt. Class. 60% of which will be obtained. 60% of which will be obtained. Now, the question is telling you that the project will be financed entirely by debt. 60% of which will be obtained from a subsidized what? Loan. Don't forget, the cost of this project is 760. Is 760 million. And there will be a working capital. And there will be a working capital. Where is it? Okay, there will be a working capital that there will be a working capital of 20% unanticipated. But in this paragraph, you were told that the project will be financed by debt. The 60% class. What it indicates is that both your working capital will be borrowed. The cost of the investment will also be borrowed. We form part of what they will borrow, because the project will be financed entirely by debt. Both your working capital and that investment amount will be financed by debt. So addition of the two will be financed by what? By debt. That is what it means. 60% of which will be obtained from a subsidized loan scheme run by the what? By the government. When you add the working capital plus the cost of the investment, you charge the 60% will be financed from the subsidized loan by the government. Will be financed by subsidized loan. Then which lend money at a rate of 100 basis points below the 10-year government debt yield of 2.5%. Class, I've been saying this in the previous lecture that Ican can decide to lock the financing effect, scatter it to the extent that you will now ask yourself, what is the commercial rate? What is the subsidized rate? You start looking for it, and this is how it may be locked. Which lend money at a rate of 100 basis points below the 10-year government debt yield rate of 2.5. Below it, 100%, that is 100 basis points, that is 1%. Below the government yield of 2.5, which means that 1% is below it. So if you remove 2.5, you remove 1% from 2.5, what do you have? You have 1.5. So 1.5 is the subsidized rate. The 1.5 is the subsidized rate. They say, if they want to subsidize it, see, you are supposed to lend it. The government is, let's say, 3%. The government will now say, oh, we'll subsidize it 10% below the 25%. 10% below it, 10% below the 25%. It means that you have to remove 10% from 25%. What do you have? You have 15%. 15% will be the subsidized rate. That is what it means. Class, are we still together? Okay. Now, issue cost related to rising the finance are 2% of the gross finance required. Gross finance required. What is the gross finance required? The gross finance required is that it will be financed entirely by debt. It will be by what? By debt. The issue cost will be on debt, right? And they said it is issue costs related to rising the finance are 2% of the gross finance required. The finance required is that if it is financed, 60% will be financed by subsidized, right? So the issue cost will be applied to the subsidized as well, which is what? Which is the 2%, because they say just finance required. What is the finance required? Is 60% of the subsidized loan scheme from the government. Then what will happen to the 40%? The remaining 40% will be funded from FC normal what? FC normal borrowing sources. Class. And the normal borrowing sources of FC is 150 basis points. The remainder, which is 40% of the total amount, will be funded from what? FC normal borrowing. It can be assumed that the debt capacity available to FPLC is equal to the actual amount of debt finance raised for the what? For the project. So what it means is that the debt that is available, they assume that their debt capacity is equals to the amount at which they raised that they will use to finance the what? To finance the project. You see, this part, very technical part. We will still talk more about it as we move on. FPLC has identified a company. This is the Proxy company, KPLC, which operates in rice mill industry. KPLC, please, this is the Proxy company, KPLC, right? KPLC is financed 40 million shares trading at 64 naira per shares, right? That is the market value of equity shares. 680 million debt trading at what? 940 naira per debt per 100 naira debt. KPLC equity beta is 1.5, right? The current yield on government treasury bill. Class, what is treasury bill? Treasury bill of 2%. Treasury bill is what?
It's
Is it risk-free?
Okay, risk
Government
free. Thank you.
security.
Thank you, risk free. And it is estimated that the market risk premium is 8%. KPLC pays tax at annual rate of 20%. Both FPLC and KPLC tax in the same year as when profit are earned. Required class. Determine the adjusted present value. Very simple, right? Let me drink water first. Omo, before we start this thing, please a minute. You see, I will not come to this class. Cost of equity of the ungeared company. When you are to determine the cost of equity of the ungeared company, there are two formulas, the Modigliani-Amida and the other formula, right? So this is a solution. So ungeared cost of capital class. So in this case now, from this question, if you have the material for those who have paid, right? From this part of ungeared cost of equity, don't forget all this is talking about equity. These are equity, right? All this part is talking about what? Equity. Now, the question now is, how do we determine the ungeared cost of equity? Class, are we using Modigliani and Miller, or we should go by the other method? Hello, class.
Let's use the
Hello.
other method.
Okay. Why do you say we should use the other method? Why? That's basic
Because it's a, it's we have been learning it from the risk of risk of a cost of capital, the adjusted cost of capital, and
okay, okay,
you
that's
understand what I'm trying
fine.
to say? Like it's a continuation of what we have been learning.
Yes, yes. Okay, that's fine. So the unget cost of equity, we would have used Modigliani and Miller. But guess what? Modigliani and Miller will not work. Why? Because the cost of the get company, the cost of equity of the get company is not given. They did not tell you that the cost of equity of KPLC is equals to 13%, just like the other one that we did. So in this case now, we have to go back to the way we normally calculate it. We have to go back to the risk adjusted cost of capital, right? So we have to identify the proxy company as KPLC. Identify the proxy company, right? Which is what? KPLC, right? Now the next step is to calculate asset beta, right? The next step is to calculate asset beta. Let me quickly copy this format. Asset beta, asset beta, asset beta, asset beta. Where is it? Asset beta, asset beta. Okay, asset beta, right? So now, if you want to determine the asset beta, we need right? We need what is it called? We need the BE and VE. Don't forget that, class, beta debt is not given in this question. Beta debt is not given in this question. The beta debt of the proxy company is not given in this question. So therefore, the beta debt will be equal to 0. So all these parts, we don't need it. This other part here, we don't need it. Right? We are going to use this. Right? Now, this is very simple
You
because
can't see your screen.
uh, we again can't see my screen.
I
You
can
will say you can't see my screen.
You can see now.
Is your network? Oh? Is it my network or your network? Okay. Okay. Now, class, we don't need beta debt is equals to 0. Why? Because the beta debt of the proxy company is not given. When you look at this part now, there is nothing like beta debt. The only thing we have here is equity beta. The only thing that we have here is what? Equity what? Equity beta. So therefore, this part of beta debt will be equals to 0. We don't need it. Now, beta debt will be easy to calculate, unlike the other method, because the equity beta here, equity beta of the proxy company is given to us in the question. It will be very easy for us to calculate because the equity beta of the proxy company is actually given to us in this question, class. So therefore, we will say BE, we'll say BE. So what is the equity beta of the proxy company, class? What is the equity beta of the proxy company? That means you don't have the question.
1.5.
Okay, let me go back. 1.5, right? This is the equity beta of the proxy company, 1.5. 1.5 times, don't forget, equity beta, value of equity. Don't forget, when equity beta is not given to use, you have to use the CAPM formula to get your cost of equity. By then, the cost of equity will be given to you. That, oh, cost of equity of the proxy company is this, will be given to you. So you can make it the subject of the formula to get your equity beta, just like the way we solved the first question. Now, in this question now, you should observe that there are two different things. You should observe that in this question now, equity beta is given to you. right? So sometimes the asset beta may be given, class. Sometimes asset beta may be given. When asset beta is given to you, you don't need to calculate asset beta. Just move to the next step. Use it to calculate your what? Use it to calculate your cost of equity and get your cost of equity of the ungeared company, and you move on. Please take note of that case scenario. So, class, the value of equity of the what? Of the ungeared company. Now, let's go back to it. What is the value of equity? KPSE is financed by 40 million shares trading at 40 million shares trading at what? This 64 naira per share is what? This 64 naira per share is what? Class, this 64 naira per share is what? The 64 naira per share is
It's the
what?
value of the equity.
No,
The value of the equity.
no.
Market price per share.
Yes, that is the market price, right? Market price of equity. That is the market price of equity per shares. 64 naira per share. This 64, it is not in million. It is 64 naira per shares. And they are to trade 40 million. What is the value of the shares? That is what is the market value of the equity trading. So in this case now, the market value will be the 40 million shares times the market price, 64 naira per shares. So what is the value? You can see that Ican in this question, they did not bring it in form of gearing. They didn't bring it that, oh, debt to asset ratio. You can see that they change format. So you can see different scenario. It is not must that they will tell you that it is debt to equity, oh, it is 50%, this one. No, it may come in this form. Then prepare for it. This is market value of equity. The market price, if you go to NGS today, the market price of the equity, the market price of maybe say one of the bank per shares times the volume traded, the closing volume traded as at today, we give you the market value of equity of that company as at today, and that is the what? The VE. So the next one is VD, which is the value of debt, right? Please multiply. What do you have? Quickly.
2560.
2560, right? Million.
Yeah. 2560, yeah.
Okay. Okay. I think this call will end in 4 minutes, right? Okay. Coming. Okay. Before we create another link. So value of debt. So we're given that the value of debt. Can you see it? The value of debt. I'm taking you back to cost of capital. Class, if you want to calculate the market value of equity, this is it. Oh. They did not give us the nominal. See, in another case scenario, these 40 million shares, they may not give you 40 million shares. It may be maybe 40 million naira, and trading at 64 naira per shares. You know, you need to get the numbers of shares. The nominal price will be given to you as 1 naira per shares. You divide the 40 million naira divided by the nominal price, we give you the numbers of shares. Don't forget, we did
Sorry,
the
sir,
same.
the call ends in 3 minutes.
Okay, no problem. That's fine. No, don't forget the way we did it under the cost of capital. Go back to the cost of capital, how to determine the market value. This question may come in another form. 40 million naira. The nominal price, 1 naira. The trading price, 64 naira. Now, for you to get the numbers of shares, divide the 40 million divided by the nominal price. We give you the numbers of shares. Times the market price. We give you the value. We give you the market value of what? We give you the market value of equity. Class, you can see that the knowledge of cost of equity presuppose adjusted present value. You need to understand the risk adjusted cost of capital before we talk about what. You need to understand risk adjusted cost of capital capital budget as well as the what is it called? As well as cost of what? Cost of capital. So let me quickly create another link so that we can, the worst case scenario, class. This is, to me, this is just straightforward way of calculating market value of equity. Please refer back to cost of what? Cost of equity, please. You can watch the video on step-by-step approach on how to determine weighted average cost of capital. Go back to the YouTube, it's there. Just go back to the YouTube, it's there, please. Now, if we have determined the market value of equity, right? So the next thing is, this is the trading for the debt. Is that not so? Don't forget, this per 100 naira is the nominal value of a debt, which is 100 naira or 1000, but it is 100 naira. Is that not so? This is the amount at which the debt is being traded, 94 naira, and you have what? You have 64 what? 64 million as the what? As the debt. So therefore, please, who is that? Mute your mic. So therefore, 64, what is the value, self? 680 million, right? So we can have 680 million times 680 million divided by the nominal value of the debt times what is the market price? 94 naira. 94 naira. So class, what do you have? What is the market value? What is the market value, please? What is the market value? Quickly. Class, what is the market value?
639.2.
Oh, thank you so much.
Okay. 639. 639.2 million. Now, what is the tax? The tax rate. Sometimes you may be given different tax rates. The one of Posy company will be different from the one of the main company. But in this question, we only have, it's part of the assumption you will state that the annual tax rate of 20% is assumed to be for KPLC as well as FPLC. It is an assumption because it is just one tax that is there, which is 20%, right? Which is what? 20%. That is 0 point what? 0.2. 0.2. So we can move on, right? We've gotten all the elements we need to determine what? To determine the asset what? Asset beta, right? To determine the asset beta. So we can change this. We can we can insert it here. So asset beta is equals to this and this, right? So BE, which is equity beta, is 1.5. 1.5. The value of equity, coming. So the value of equity, what is the value of equity? The value of equity is 2,560,000, right? What is the value of equity? 2,560,000. What is the value of debt? 639.2. So what is the tax rate? 0.2. Class, I just need the final figure. So what is BA? Give me answer. What is the BA?
7.509.
Okay. Please confirm.
BE is 1.25. Which one?
1.25.
So 1.25. Please, you can check your calculator. So 1.25 is the BA. Don't forget, what is the next step? Is assume that your BA is your equity beta. You don't need that the next step. Just calculate your what? Your CAPM, so that you will get the cost of the ungeared company, class, so that you get the what? The cost of the ungeared company. So quickly, let me quickly copy this. Oh, where is this? Oh, where is this? Where is this? Where is this? Where is this? So let me quickly copy this, right? And paste it to the last page. Okay. So 2 and 3. Please, if you don't understand, let me know. If you don't understand, that means you did not go back to the previous lecture on adjusted present value. So therefore, do we have risk premium? Cost of equity of the ungeared company equals to, what is the risk free? What is the percentage for risk free? Class, what is the percentage for risk free?
2%. 2%.
Okay, 2% plus BE. You know, you assume your BE to be asset beta. So we have 1.25. Are you given premium? Is that premium?
8%.
Is it premium? Is it market premium?
Yes, market risk premium. Market premium is
Okay. Okay. So please mute your mic. Thank you. So what is the cost of equity? Please, please. And I don't know what is happening. And some of you are here to get the material, right? See, guess what? It is not because of me. It is because you are going to use it. It is not because of me at all. Get your material. As we are writing it, you can see the way we are displaying it. I will not need to be going up, scrolling up and down. Get your material, and so that you will be on the same page with us. Thank you. Now, so what is the cost of equity? What is the cost of equity?
12.
12%.
Okay, 12%. So the cost of equity is 12%. Now, this is the cost of equity of the ungeared company that we will use to discount the base case NPV class. The base case what? The base case NPV. So now we are starting with base case NPV. Base case NPV. Right? Base case NPV. So this project will last for how many years? What is the numbers of years for this project? We need to know. Based on the question, how many years?
4 years.
Okay, the project is expected to last for what? For 4 years. Can you see it? The project is expected to last for what? 4 years. So we can start from year 0, from year 0 to year 4. So why? We would have extended to year 5, but the tax is being paid in the year at which the profit is being made. So that is why we don't need year what? Year 5. So we start. Please, we must complete this question tonight. Please, we must complete it today. We'll complete it. So 4, right? So what do we have here? So in million. So I can copy this. Oh, in million. Million. Okay. So we start from what is given to us. We're given revenue, right? For those who are with the material, you are given revenue. And at the beginning of this class, we read that revenue will increase. Is that not so? Okay. So let's quickly go back to the question. Can you see the revenue given to us? 460. I will not scroll up again. No. So you just give me a figure. You inflate it. Now, look at it. In this part, you can see that it is estimated that the inflation rate applicable to sales revenue is 8% per year, and to direct project cost is what? Is 4% per year. So class, are we still together, please? Class, are we still together? So we have to inflate the revenue as well as the what? The direct project costs. Are the what? Direct project what? Direct project cost. So quickly, the revenue, right? We inflate it. Revenue will be inflated by how many percent?
8%.
Inflated.
8%.
Okay, thank you. Inflated by 8%. 8%. Okay. So class. So inflated by 8%. So the first year, raised to power. So you know the way we normally do it. So I will just do the. I will solve for 1 year. You do the next year. I will solve for 2 years. Then you do the second year. So what is the revenue given to us in this question? What is the revenue for year one? The revenue for year one is
460.60.
what? Is what?
460.60.
460.60 times, it should be inflated by 8%. That is 1 point what?
08 raised to
1.08.
power 1.
Thank you. God bless you. God bless you. Raised to power 1. Thank you. That's perfect. Raised to power 1. Right? Because it is based on yearly basis. So what do you have?
497.45.
497.45. That shows that you've been following, right? That makes sense. Year 2. So what is the sales value given to us in year 2? That we will increase it. What is the sales value given to us?
732.
732 point what? Is it 732?
Yes.
Okay, 732 times, it will increase by 1.082. So what do we have?
854.
Okay,
Approximately.
good. 85, no approximately, just leave it like the way we normally do.
53.80.
Thank you. So you can see, now, in this question now, something should come to your mind that what if I can just give you only one revenue of 460 and they say it is inflated by 8%? Don't forget that we've done something like that before under capital what? Budget. Now, you are given only one revenue of 460 and it should be increased by 1.08. What you need to do is that, in that case, when you multiply it, you have 497. You bring the same 497.45 to the second year, inflate it again. The answer that you get, you take it to the third year, inflate it again. And that is what we did in our first class under the capital budget. Please refer back to what? Capital budget. But in this question, we are given different revenue. You have to inflate it, right? You have to do what? Inflate it. Raised to power by the what? The numbers of what? The numbers of years. So I won't do other one again. You can do the rest, right? So this is what? 497.45. So what is the next one? The next one is 8. Gift. Gifted.
981.
Okay, I'm coming. Gifted.
Yes, sir. Good evening, sir.
Good evening.
Yes, sir. I'm getting confused with the way we are solving for this inflation. The first year we did 460, 0.60 times 1.08, right? They say inflation rate is 8%. Why are we raising it to the power of the number of years?
Yes, that is it. It is yearly inflation.
Okay.
It is yearly inflation.
But,
Gifted.
but what of the ones we do normally without like raising it to the power of years, like just like 732 times 1.08 on a
Go
normal?
and check. Have we done something like that before? Refer back to capital budgets. We didn't do something like that. What we did was that they gave us only this, only one figure for revenue. Please mute your mic. They gave us only one figure for revenue, and we reinflate it. I've forgotten the percentage, and we raise it to power of 1. We get the figure. This same figure, we take it to the next year. We raise it to power of 2 because it is a cumulative. But in this question, this is yearly. It will be raised to power the numbers of years. Gifted.
I'm with you, sir. I'm with you, sir.
So do you get that? So you can check what is it called? Check capital budget from part 1 to the last part. You will have understanding of it. But the reason why we raise it to power is because it is a yearly inflation. So it should be raised to power by the numbers of years.
Okay, sorry. So basically what you're saying is if in a question they state that the inflation is yearly, we raise it by the number of years.
It
So
is per
in
year.
okay, where it is not stated.
No, it will not be like that. They will not even you should know that inflation is yearly basis. It is yearly basis. But in this question now, did they tell you that 8%? 8% is per what? They say it will increase by 8% per what? And sometimes you can see 8% per year. So it will definitely be stated that it is per year. Sometimes they will tell you that 8% in the first and second month, 10% in the third and fourth month, 5% in the next 6 and 7 months. Inflate it like that based on the inflation rate given to you.
Okay, sorry, please. Sorry. So like this example you gave now, if it stated that okay, the inflation is to be inflation for first and second year is 8%, then third year maybe 9%. So that means we don't have to do this raise to power the number of years for the first 2 years that the inflation rate applies to, right?
For the first 2 years. No, you still do the raise to power the numbers of years.
I'm confused.
You are confused. Okay. Refer back, go and check capital budget, please. Check the capital budget and you see the way we actually solve a question there, please. You can check it. So I guess you were not in class when we discuss a capital budget. Gifted.
Yes, I
Please
was
check
not
back.
in class.
Yes,
Then
please check back to capital budget. Thank you. So, what is the next inflation, please? The third year is what? What is the third year? Quickly.
1,236.8.
1,236.28.
0.28.
Next, what do we have?
738.47.
738.47. Okay. So the next is direct cost. Direct what? Direct project cost. Direct project cost. So it will be inflated by. Now, I want to ask you a question. Gifted, are you there? Now, if I'm inflating it by this, like now, this direct project now, I want to inflate it by, I'll inflate it by 4%, right? Now, that figure that I get after inflating it, what does the figure cost? Is it money cash flow or real cash flow? Gifted. Okay. Gifted, are you still there? Okay. Now, inflate it. How many percent? This is by
4%.
4%. By 4%. So I'll just do the first 2 years, which is direct project cost. Year 1. So what is the year 1? The original cost. Original cost. You say, what do you have?
276.40.
276.40 times, it will increase by 4%, right? 1.04 raised to
Yes.
power 1. So what do you have? What do you have? Please, quickly.
287.46.
Two what?
287.46.
Okay, I'm coming.
287.46.
Okay. Okay, 287.46. Okay. Year 2.
432.20.
432.20 times 1.0 for raised to power 2. Raised to power 2. Okay. Okay. I think someone wants to ask question. If you want to ask question, just submit your mic quickly. But
Hello,
just
sir.
have it at the back of your mind that we must complete this question today. What is the
Hello, sir.
figure? Just give me figure for. I'm coming. Sorry, sir. What is the
Sir,
figure?
475.46.
it is 439.2.
Okay. 439.
0.2.
439.
I mean, the real cost of capital is not 432, sir.
Okay. 43 what? Please
439.
mute your mic. If you are not talking, please mute your mic. Okay. So the real cash flow. The real cash flow is what? For what? What is the real cash flow?
39.
Okay, 439. So what do we have here?
475.04.
475.04. Okay, the person should omit his or her mic and ask the question before we move ahead, please.
Hello, sir.
Yeah, I'm with you.
Please, how do we get the figure that we are inflating? I know for the first year is being given in the question. How do we get for the second year and the
Okay, okay. Do you have
subsequent
the
year?
material? Okay, do you have the material?
No, sir.
Okay, that's fine. That's why you didn't get it. They called it from the material. Please, immediately after this class, please, you need to get the material, please. Please.
Okay.
So that as they are giving us the figure, you can check it, you can confirm. It's there in the question. Let me quickly go back. Coming. Okay, can you see it? I highlighted it at the beginning. Can you see it? It is estimated that the inflation rate applicable to sales revenue is 6%, while the direct project cost is 4% per year. Can you see it? Hello? You asked question, no? Okay, let's continue.
Maybe it's their network.
Okay, it's fine. So this is what 287.46, right? Why this is 475.04. So what is the third year class? The third year is what?
6.32.
Okay. Instead of this, let me just put less. You coming? Should be too much. Okay. Sorry, just a minute. I need to arrange this thing. Wait, so we will not mix it together. Yes. Okay, what do you have here?
662.32.
662.32. Okay, thank you. Next, what do you have?
380.91.
Okay. 380.91. Pemisire, are you still in this class? Where is Rachel?
Yes. Yes, I'm
Okay.
here.
Okay, that's fine. What of Benjamin? Are you still with us or against us? Are you still with
Yeah,
us or against
I'm with
us?
us. So good evening, sir.
Yeah,
I
good
know I'm
evening.
with us. Good evening, sir.
That's fine. So now that is the incremental, right? And don't forget, anything that has to do with interest, it is not allowed because this interest will form part of your cost that you use to discount the project, right? Anything that has to do with interest elements, it is not, you will not consider it as what? As relevant, as what? As a relevant cost, right? So after that, we have profits. Is that not so? So in this case now, class, we don't have any other thing again aside working capital. Our working capital, can you see it? Our working capital, our investments, tax savings on capital allowance. What other thing again? Working capital, right? So these are the things that we need. So therefore, we can have cash flow, net cash flow before tax. So please give me the difference. What is the difference between these two? Net cash flow, net cash flow before tax. So what is the net cash flow? What is the difference? Quickly.
209.99.
Yes, year 4.
Year 4. What do you
Okay,
have?
year 4 is 357.56.
0.56. Okay. Year 1.
209.99.
Okay. 209.99. Okay.
378.76.
378.76. Okay.
Year 3, 573.96.
576.
73.96.
Okay. 573.96.
573.96.
Okay. Now, class. Okay, I'm coming. Let me finish this part first. Tax. So how many percent is the tax? 20%, right? 20%. 20%. So what is the 20% of this? Quickly. 20%. You know, tax is being paid in the year at which the profit arise, right? So quickly, class, quickly. What is the 20%?
Year 3, 114.79.
Why is it that you always start from the last year? If you didn't start from the last year, second to the last. What do you have?
114.79.
114.79. That's fine. So quickly, figure.
Year
Year
1.
4.
Okay.
Okay.
Year 4.
Year 4 is 71.51.
Okay, 0.51. Okay,
Year 1 is 41.99.
41.99.
Year 2 is 75.75.
75.75.
75.75.
0.75. That's fine. Thank you. So what is the so this is the task, right? Now, don't forget that we have the cost of the assets. Class, if you know you did not understand, if you did not understand what we are doing, please unmute your mic and ask question. Oh, please unmute your mic and do what? And ask question. Now, we still have what is it called? The investments of 760. We have working capital. Then we also have what? Tax savings. Don't forget that this is expected to be sold 80 million when the project ceased after making any taxation and inflation. Is that not so? So the next is the cost of the assets, the amount that is being sold, right? Then we will now bring in the capital allowance or the tax savings. We'll bring out everything. Please mute your mic. Okay. So what is the investments? Investments. The investment is
760 million.
760. Thank you. 760. Right. So they sold it at the end of the year. Of course, that is what is being stated, right? At the end of the year, it was sold at 80 what? At 80 million when the project ceased. When the project ceased is at the end of the year, which is at the end of year 4, class. Because at the end of the year 4, you will not continue the project. And that is what it means. So you can say sales proceed. And they say it is after tax, after tax, after tax, after tax, after tax, right? 80 million. That is the sales proceed, right? Now, if this is the sales proceed, the next is the working capital or the tax savings. Let me just put it as tax. Which one should they start with? Working capital, tax savings. Working capital, tax savings. Okay, working capital. Next, tax savings. So we'll need to work the working capital as well as what? The tax savings. Who is that? Please submit your mind. Who have question? Okay, Benjamin.
Yeah, sir, it's me. Yeah, this
Okay.
80 million that we put under year 4,
Yeah.
how are we to put it?
How
How are we to know the exact under which year we are to put the 80 million?
are you with the material?
Yeah,
Okay. Please make sure you print your material out, okay? Let me show you. At the beginning, you are not, when we start the analysis, I don't think you are in this class when we start the analysis, right? I don't think so. This is it, which is expected to be sold for 80 million when the project ceases. This project will last for 4 years. Will last for 4 years. Will last for 4 years. After 4 years, is there any other project? No. So that the last year is the year at which the project will be what? Will be ceased. And that is why we use 80 million for year 4. Do you understand?
yes, sir. Thank you very much.
So are you good now? Are you good?
Yeah, good. Thank you.
Okay. Yeah. Okay. So if that is established, right? So the next thing is let's talk the working we should deal with the tax savings first. Let's talk about the tax savings. Can you see it? It's step by step, right? Tax savings. We need to do our tax before the working capital, please. So can you see that tax allowable depreciation is available on the plant and machinery? right? Don't forget, out of 760, 320 is plant and machinery. And this plant and machinery will be sold at 80 naira, 80 million. That is why we say sales proceed at the end of the year. Now, the tax allowable depreciation. Tax allowable depreciation means that depreciation will be subject to tax allowable, which means that you have to do capital allowance on it. It is allowable. It's available on the plant and machinery at 50% in the first year. So when you want to do your capital allowance, you charge 50% on 320 because the 320 year is the plant and machinery. And thereafter, on reducing 25% on reducing. So next, so you now be charging 25%, 25%, 25%. So at the last year, which is the fourth year, you will now have, because the plant and machinery will be sold for 8 million. So you will now have an adjustment, either balancing charge or balancing allowance. Class, if you don't have the material, screenshot this part. Okay. So we move to capital allowance, right? So let me put this, I need to copy this down. This will come first, tax savings. Okay. Tax savings. So this is tax savings. Coming. This will be year 0. The year 0. So what is the cost of the assets? Is 3 million. Let me put this thing here.
320.
Oh, sorry, 320. Thank you. Year 1. So year 1. We need to, this 320 is the cost of the assets. I'm coming. Let me remove this here. Control C. Right. So how many percent? Okay. So the capital allowance is on plant and machinery, which is 320. The 50% will be charged on the 320 in the first year. Then this is the capital allowance. Charge 20% of this, you have 32. Then the tax will be due in what? In year 1. So 320 minus 160 is what? 320 minus 160 is 160. In the second year, we were told that in the second year, you will charge 25% of 160, right? 25% of 160 is what? 40. You charge capital allowance of this, then tax savings on it, 20% of 40 in the tax deal. So the next year is 25%, right? Because it is on the reducing balance method. 25% of 120 is what? 30. So the 30 is the capital allowance. You charge 20% of the 30, you have what? You have 6 million. And it will be receiving what? Year 3. Now, in the final year, they make a sales proceed of 80 million. Don't forget, under the capital budget, when the tax written down value is higher than the sales proceed, there will be a balancing allowance. In the other way around, when the sales proceed is higher than the tax written down value, you have balancing charge. Now, when you have a balancing allowance, it means that you make a loss on the disposal of that asset. So you claim capital allowance on it, and that is why we have 10 here. So what is the tax savings on it is 2, and year is year 4. Then, however, if it is balancing charge, you don't need to claim anything, but rather you have to pay tax. We will charge tax on it. You pay tax on that amount, right? You pay tax on that amount. Why? Because you make a gain on the what? On the disposal of an asset. Class, are we still together, please? So in this case, are we still together, please? So in this case, we can now continue. Benjamin, leave your question. when we are done, please. So in this case now, we need to continue with working capital, right? We are done with the tax savings, 32, 8, 6, and 2, right? So the next is working capital. And we are told that the working capital is 20% on the anticipated revenue. Don't forget, on the anticipated what? On the anticipated revenue, right? Now, in this question now, we have anticipated revenue, right? What is the anticipated revenue? We're given the anticipated revenue. This is the anticipated revenue. This is it. So we need to charge 20% on it. Revenue. So we need to charge 20% on it, right? So 20%. So let me close this. Let me quickly close this so that you will not okay. So the working capital, 20%, right? 20% of revenue. So what is the 20% in year one? What is the 20%? What do you have in year one? Quickly. What is 20%? Hello?
99.49.
Okay, I'm coming. 99,
0.49.
99, 99.49. Okay. What do you have? 20% of year two, what do you have?
170.76. 70.76.
170.76. Year three, what do you have? Year three.
247.26. 247.26.
Okay. 247.26. Year four, what do you have?
147.69.
147.69. Right? 147.69. Right. So, which means that at the end of the year, you will give me this balance. That this is my money, because I've been running the business from from January to December. Don't forget, the question is saying that at the last year, you have to pay me back my money. Don't forget, working capital is what you use in running the business. Can you see it? Any remaining working capital will be released at the end of the what? At the end of the project. What is at the end of the project is what? Year what? Year four. So in this case now, we need to change. Usually we will now say changes in working capital. Changes in working capital. Please also refer back to capital budget where we did the same thing as this, right? So the changes in working capital, it will be, you start from year zero. In year zero, there's nothing there, right? So you will say 0 minus 9, 0 minus 99.49. So in this place, you have 99.49 as your year zero. So your changes is in between your year one and your year two. You want to know if your working capital is increasing or not. From year zero, you didn't have anything. So that is why I say year zero, 0 minus 99.49, you have your minus. So just bring the one of year one to year zero. Now, from year one to year two, the difference is your working capital increases. What is the difference? Is it increasing or decreasing? What is the difference between year one working capital and year two working capital? What is the difference?
71.27.
Okay, 71.27. So, which means that the working capital increases, Abi, right? The working capital increases, right?
Yes, sir.
71.27. You can see it now. is the difference between these two. You can see your working capital from 99.49 class. From 99.49, it increased to 170. What is the increase? That is why in valuation of a business, we call it changes in working capital, or you can call it an incremental, right? Mostly it's changes in working capital, right? So you still compare your year 2 and your year 3. What is the increase? Do you have increase in working capital or decrease in working capital from year 2 to year 3? What is the difference? Do we have increase or decrease?
Increase 76.5.
76 is an outflow. When
Point
you have
five.
an increase, it is an outflow. It means that the money you use in running the business is increasing. So it will reduce your cash flow. That is what it means. What do you have? What do you have? Quickly.
76.5. 76.5.
76.5. 76.5. So the next one is from 247 to 26 from this part here. Okay, we've compared this. We'll compare this year 1 to year 2. Okay. Now 24 from 24 to 147.69. Did it increase?
99.57.
Thank you. Is your working capital increases? Does it increase?
It reduced.
Decrease.
Decrease. Pemisire. Pemisire.
Yes.
Hope you know what you are calculating, right?
Yes, now
You
the
understand?
difference between 247 and 147.
Okay. So that is a decrease, right? That is a what? That is a decrease. Is that not so? So that is why you don't need to put it in brackets. Why? Because the money you spend, it reduce. Is that not so? When it reduce, it will increase your cash flow. That is what it means. So when you have an increase, when you have an increase, it will reduce your cash flow. But when you have a decrease, it will increase your cash flow. That is what it means. So at the last year, 147.69 minus 0, you have 147.69, right? Because at the end of the year, you have to recoup back your investment. So you have 147.69. And this is your working capital. This is what we will use in our what? In our capital budget. That is what we will now put in our capital budget. So if anyone have question now, Benjamin, if you have question now, you can now ask your question. So that I can answer the question all together. So if you have question, you can unmute your mic. So if you want to know how we calculate it, okay, unmute your mic.
Yes, I've done that.
Okay.
Can you hear me?
Yeah, I can hear you.
Okay, so my question is the last page before we go to this place where we calculated taxes.
Yeah.
Okay, so now the difference between this tax written down value and the sales proceed, that's 90 and 80, gives balancing allowance of 10, right? So
Yes.
how did we get this capital allowance? Are we claiming the whole 10 naira as capital allowance?
Yes, you claim the whole 10 naira because you make a loss on disposal of the assets. So do you want to claim half? Oh, you claim half and leave half for the company? You claim everything. If you own the business, right? You have a limited liability company and you make a loss on disposal of an asset, you claim capital allowance on it. And that capital allowance, what will you use it for? You use it to reduce your tax liability at the end of the period. That is what it means. Is
So
that
by
clear?
implication, now, if the balancing allowance happens to be 50, the capital allowance too will still be 50 as well, right?
That is what you claim. That is why I have to put it like this so that it will show that you claim your your balancing allowance is 10. You claim the capital allowance, which is 10. Do you want me to remove the 10? I'll just put 10 here at this middle. so that you know that it's 10. I'll just put it 10. I don't want to do it like that so that you understand. That is why I now
No,
separate it
no,
that
sir, it's
your
fine like
balancing
this.
allowance is 10. Your capital allowance, you claim the capital allowance, which is 10. 10 minus 10, 0. Or should I remove it?
No, sir, just leave it like that. Then the second question is, suppose it's a balancing charge. You said that means it's a gain, and we'll have to pay tax, right?
Yes.
So now, the figure for the tax, is it going to be in brackets? That's under
Yes,
this
yes,
tax
yes. Now you
savings.
pay, yes, you pay tax on it. You can just do it separate. You can just come down and just do it separate. Maybe you make 40 million, charge tax on it times, wow, times, wow, times 20%. You pay 20% on it. So what is the tax? So you pay tax on it. If the tax is 10 million, right? If the tax is 10 million, 40 minus 10 is what? Is 30. That is what you realize. You can post 30 in the capital budget. You can still post it at, oh, 40 million service balancing charge, but just do it like this. Once you just calculate it, 40 million times 10 times 20, what do you have? You have 10. So therefore, you pay tax. When you pay tax, what is the balance? Minus 10 million. Minus 10 million, right? What do you have? You have 30 million. So post the 30 million as your balancing charge. After this net, you can say net balancing charge because you deduct the tax that you paid, then you post it at the end of the year. Do you understand? Hello, Benjamin.
Yeah, yes, sir. My network threw me out. I didn't get the explanation. I'll go through the video after the
Yes,
class.
yes, yes, please. That would be fine. Thank you. So,
All
and
right. Thank you very much.
no, thank you. So, and this is for the working capital, right? So we have to pick this, right? So please refer back to capital budget so that you will have more understanding on this what capital work, on this working capital. We'll still do more of this working capital when we get to free cash flow. We can't even escape all these things. We still do more on all this working capital, right? When we get to free cash flow to the firm and equity, we need to do it as well. So you have to have an understanding of how it works. This is the revenue. The question says 20% on the revenue, yearly basis, year one. Now, working capital will start from year 0. This is it. Pick the first year will be year. Or you say, oh, 0 minus 0. You know, the first year is year 0. 0 minus 99.49. Bring it forward to year 0. You have minus 99.49. It means that your working capital increases from 0 to 99.49. In your year 2, what is the difference between these two? 99.49 increased from 99.49 to 170.76. It increases, which is 71.27. From 170 to this, it increases. It increases to by 76.5, right? From 247 to 147, your working capital that you use to run the business is decreased, which means that your cash inflow, you have more money. That is why you don't need to put it in bracket. In the last year, you have 147.69 minus 0 because you don't have any other thing. Minus 0, you recoup back your investment, which is what? You're positive, right? And that is how we calculate this part. So in this case, we come back to working capital. Please screenshot this part so that you can just give me the figure. This is working capital, right? So that you can give me figure, please. Working capital work for. So what is year 0? Working capital year 0. Working capital year 0.
99.49. 99.49.
99.49. Okay, next, what do you have?
71.27.
71.27.
27.
Next,
76.5.
76.5. 99.5. Positive. Next.
Negative.
Okay, negative. Okay, next.
99.57 positive.
99.57. Next.
147.69.
147 point what?
69.
69. Thank you. So do we have any other information? I think no, from what they give us from this question, except this financing effect. We'll come back to that. That is the preview of financing effect. So the next thing is we need to discount. We need to do what? We need to discount. Don't forget, I've explained this part to you several times. Please, you can go back to capital budget as well as you can rewatch the video again, this particular lecture, so that you have an understanding of this. Now, since we have inflated the cash flow, so we have to use the nominal cost of capital to discount. It is given already as 11%. And even this is not given as 11%, we would have converted this real cost of capital, right, to money cost of capital. Real means that you've not taken effect of inflation, right? Then when you include inflation to it, you will not get money cost of capital. But let's quickly test this 11%. If we will get this 11%, class, we need to convert this real cost of capital to money cost of capital. We want to test if we will get this 11% given to us. Don't forget, the inflation rate is 4%. That is the general, which is what that you will use to convert it. Real cost of capital is 7. Inflation is what? 40. So if you want to convert a real cost of capital to money cost of capital, class, what is the formula? If I want to convert the real cost of capital to money cost of capital, what is the formula?
1 plus M.
Money cost of capital. Please refer back to capital budget. Money cost of capital, open bracket, 1 plus the real cost of capital, open bracket,
1 plus
1 plus inflation. Thank you.
Is equal to 1 plus
minus n minus 1. Thank you. So in this case now, we want to test it if that 11% is correct. I've told you that sometimes Ican may decide to remove that 11% so that they want you to go and use this real 7%, and that will be wrong because you cannot use real cost of capital. You can't use real cost of capital. You can't use real cost of capital to discount money cost of or money cash flow. It is not possible. You use money cash flow to discount money cash flow, and you use money cost of capital to discount what? Money cost of what? Money cash flow to discount money cost of capital. So in this case, we have 1 plus. So if we test it, you will see that we will have the same figure. So the R is the real cost of capital, which is 0.0707%, open bracket, 1 plus inflation rate is 4%, that is 0.04, given to us, that is the general, right, minus 1. So what do you have? Do you have 11%? We just want to test it. Do you have 11%?
Yeah, 11.28.
11.28.
11.28.
Okay, 11.2, 11.28. You can see approximately 11%. You can see. So Ican may decide to lock that question by removing the nominal, by removing that 11%. So it's now left for you to convert to money cost of capital. So quickly, I think we are done with this case. So the next thing is, okay, give me the figure, add and subtract, and give me figure. Yeah. So give me the figure quickly. What should I call this? What should I call this? What should I call this? Net cash flow. Net cash flow. Please give me figure. Give me figure so that we can go, please.
I have 859.49.
Okay, which one of the which
Yeah,
which
yeah,
one?
0. Yeah, 0.
Okay. Yeah, 0 is what?
859.49.
859.49. Thank you so much. So this will be our base case on Saturday. I thought, okay,
One
next.
to 8.7
1,
to 8.73.
1, 2, 8.73.
73.
Please confirm all these figures. Please confirm the figures. Next,
Next one, 234.51.
234.51.
0.51.
Next,
Yeah. Next, 564.74.
you don't cram the figure.
No,
Five
no,
six.
I don't do 564.74.
Okay, 564.74.
I beg,
Next,
someone should confirm. The last one is 515.74. 5.74.
515.74. Okay, oh, now it's you gave me. Oh, this figure is calculated. Disclaimer: based on what exclusive gave me in class, so you can recalculate it on your own. Thank you.
But I think it's correct, sure. I think it's correct.
so the DCF is 11 what? 11%. The DCF is 11%. So we can have the PV, which is the present value. So give me figure. This will be 1. So what is the DCF? We still don't know how to calculate DCF. Let me know, please.
0.90.
0.90. Next,
1.71.
1.71. Next,
2.44.
2.44. Next,
Sorry, please. Sorry. I think this second one should be 0.819.
I'm coming.
Discount
So
factor. Discount
I'm coming.
factor
I'm
of
coming. The last
11%.
year, I'm coming. The last year is what?
I've not done the last year. That's what I'm doing.
Please, someone should confirm this year too, if this is
Year 2
correct.
is 0.81.
81.
Mm-hmm.
Okay.
Okay, sorry. I was using annuity factor. Hey.
Oh, okay. Okay.
The third year,
Year two is
0.738.
0.81, not year 1. Year 1 is correct. 0.9. Year 1 is correct. Year 2 is 0.81.
0.81.
81. Yeah,
This one
that's
is what?
0.90.
Okay. So the last year, which is year 4.
0.81, year 2.
Ah, I'm confused now. This is the last year now. Who is giving me
Year
this
2,
figure?
year 2, 0.81, no 1.81.
Okay. Thank you. Last year, what is the last year?
0.68.
0.68.
0.68.
So what is the PV?
Year
Year
3 is 0.73, please.
0.73.
Year 3.
This is year 3. Okay. 0.73. Okay, exclusive.
73.
They give me annuity formula. They play. Oh. just they play. Class, are we good? So what is the last? This is 859.49. So when you multiply, who is that now? Who is that? Okay, Olanike.
Thank you, sir. I
Yeah.
know something. We calculated 12% cost of equity. I think we are supposed to use that.
Thank you. We calculated, how many percent do we calculate?
12%.
Thank you. I've forgotten. Oh. Sincerely, I've forgotten. That is the ungear cost of capital, right? I've forgotten. Interesting. Oh, that's 11%. That 11% is just a big trap. It's a big trap. It's the ungeared cost of capital that we use to discount it now. So why do I use 11%? Class, oh. Please use 12%. That is the ungeared cost of capital that we calculate. Please, you use, this is base case NPV class. Base case NPV. You use the ungeared cost of capital to discount. Right? Thank you, Olanike. Thank you. I guess everybody is tired. That's why. So give me figure. Give me the
Year
figure
one,
again.
0.89.
0.89. So we are supposed to use the cost of capital of the ungeared company. So next, what do you have?
0.80.
0.80.
0.79.
0.79. Year 2, right?
0.8.
Yes.
Year 3. Just give me figure. Don't worry. Just give me exclusive. Just unmute your mic. Talk. Exclusive. Unmute your mic. Talk. Oh, my system
Okay,
will
so
soon.
me, I'm saying, why are we using 12% again?
Is the cost of equity of the ungeared company. Have you forgotten that we calculated cost of equity of the ungeared company that we will use to discount the base
Okay,
case NPV?
that's true.
And I've forgotten too. Right? Rachel. I guess everybody is tired. Just give me this year so we can go, please. The one will come back, we'll complete it.
Year one is 114.57.
I'm coming. Is this correct?
Yeah,
Check
0.89 is correct.
I'm coming.
Year 2, 0.79.
Year 3.
Year 3, 0.71.
Year 4.
Year 4 is 0.64.
So we are not supposed to use that because we are not supposed to. I just test it how they get the 11%. We are not supposed to use the 11% to discount. Why? Because base case NPV is discounted using the cost of equity of the ungeared company. So next, what do you have?
So year 2 is 0.80.
Okay, calculate it. Calculate it.
0.79 year 2.
Hello. It's okay. I beg. This is it. Please calculate it. Calculate it. Get the NPV, right? Get the NPV for the base case NPV, right? Please get the base case NPV. Then in our next class, we will look at the PV or financing effect. Please,
Okay, thank you.
please go back to your capital budget, right? Go back to the YouTube, check capital budget from the beginning to the end so that you will have an understanding of this conversion from year 1 to year 2, this inflation, and I've explained it there. Another thing is your risk cost of capital as well is very important. Go back to risk adjusted cost of capital so that you have understanding of ungeared, regeared, and regearing. Is that not so? Then, lastly, your capital, your NPV, the steps in calculating NPV, which is mostly PV or financing effect, is the major problem. You see, all this one is just normal thing that we know. When we get to PV or financing effect, we have to apply the principle, right? Which has what? How many steps? 6 steps, right? In our next class, we'll first of all go finish this question under the PV of financing effect. So I think we have to go now. So thank you so much, everyone, for joining.
Thank you, sir.
And enjoy the.
Mr. Exclusive, go and read what I dropped on the group about.
Yeah, I forget that thing.